1/3 of Americans think their personal finances will be worse in the next year, according to a recent consumer confidence survey. Hi, I'm Mark with Best of Us Investors. I've been investing for 40 years and would like to share some of my insight with you today. I'm not here to tell you what to invest in, but to provide you with some information that may help you become a better investor. Please hit the like button and also subscribe to the channel if you appreciate this content. Remember, this is for educational purposes only. It is not financial advice. Okay, let's get started. Today we're going to talk about consumer sentiment. Consumer sentiment is a leading economic indicator for our economy as it measures how people feel about their current and future financial situation. You may ask, why is this important for me as an investor? Well, because consumer spending represents about 70% of our economy. When consumer confidence is low, people tend to spend less, which in turn will slow our growth of our economy. Less spending means less need for products and services. People will just buy the basics and put off discretionary spending. So today, we're going to review what consumer sentiment is and how it is measured and how it is reported. We're also going to look at a couple of economists that say they can predict future recession. Let's get started. Let's talk about consumer sentiment. A recent article in Fox Business shows that consumer sentiment falls to a new decade-long low as inflation fears soar. University of Michigan survey of consumers' chief economist says Russia's invasion of Ukraine is a major source of continued economic disruption. The University of Michigan Consumer Sentiment Index, the MCSI, a monthly survey of how consumers feel about the economy, personal finances, business conditions, and buying conditions, ended March of 2022 at 59.4%, representing a 5.4% decline from the final reading of 62.8% in February of 2022 and a 30% decline from the index reading of 84.9% 1 year ago in March of 2021. The end of March reading of 59.4% is down by 0.5% from what was already a decade-long low of 59.7 recorded in mid-March. So what's on people's mind? Well, the survey found that inflation has been the primary cause of rising pessimism, with an expected year-ahead inflation rate of 5.4%, the highest since November of 1981. So what do consumers have to say? When asked to explain changes in their finances in their own words, more consumers mentioned reduced living standards due to rising inflation than any other time except during the two worst recessions in the past 50 years, from March 1979 to April of 1981, and from May to October 2008, Curtin said. Moreover, 32% of all consumers expected their overall financial position to worsen in the year ahead, the highest recorded level since the survey started in the mid 1940s. He goes on and states he further assessed that the prevention of inflationary psychology is much less costly before it becomes ingrained in the economic behavior of consumers and firms. Now, what this means is that people start to look at rising costs and start cutting back on their spending because of rising costs. Well, that will cause inventories to grow and for producers to reduce the amount of inventory and products that they make. In addition, he talks about the confidence that economic policies will resolve the problem is essential. However, he noted, unfortunately, half of all consumers unfavorably assess the current policies, more than 3 times the 16% who rated current policies favorable. So why is consumer confidence important? Well, it's important because people that have high consumer confidence will go out and buy more products and services because they're feeling better about the economy and their jobs. When consumer confidence is lower, people start not buying as many discretionary items and not going out to dinner, not spending their money like they would if they were feeling better about the economy. So, what exactly is consumer sentiment? Let's take a look and get into it a little deeper. So, just what is consumer sentiment? Consumer sentiment is a statistical measurement of the overall health of the economy as determined by consumer opinions, which is people out like you and me. It takes into account people's feelings toward their current financial health, the health of the economy in the short term, and the prospects for longer-term economic growth, and is widely considered to be a useful economic indicator. So one of the most widely held and respected reports and indicators is the Michigan Consumer Sentiment Index, or the MCSI. The Michigan Consumer Sentiment Index is a monthly survey of consumer confidence levels in the United States conducted by the University of Michigan. Surveys based on telephone interviews that gather information on consumer expectations for the economy. So they talk directly to consumers about their feelings about how things are going today and what their expectations are going forward. The Michigan Consumer Sentiment Index was created in the 1940s by Professor George Katona at the University of Michigan's Institute for Social Research. His efforts ultimately led to the national telephone survey conducted and published monthly by the university. So the survey queries consumers on their views of their own personal finances, as well as the short term and long term state of the economy. The reason why this index is so important is because, as a whole, consumer spending accounts for about 67 to 70% of the gross domestic product in the U.S. And this indicator is regarded as one of the many important economic indicators followed by businesses, policymakers, and participants in the investment community. So if there's no spending in the economy, especially 70% of the economy, or there's going to be a positive outlook in the economy, this is very important for us to know and as a leading indicator. So how this works is each month the university conducts a minimum of 500 phone interviews across the United States, and they ask about 50 core questions, and it covers three areas: personal finances, business conditions, and buying conditions. So some of the questions that we can see being asked are the following. Would you say that at the present time business conditions are better or worse than they were a year ago? Would you say that you and your family living there are better off or worse off financially than you were a year ago? Do you think that a year from now you and your family living there will be better off financially or worse off or just about the same as now? What do you think will happen to interest rates for borrowing money during the next 12 months? Will they go up, stay the same, or go down? During the next 12 months, do you think that prices in general will go up or go down or stay where they are now? So something interesting about the survey is about 60% of each monthly survey consists of new responses, and then the remaining 40% is drawn from repeat surveys. The repeat surveys help reveal the changes in consumer sentiment over time, provide more of an accurate measure of consumer confidence. So they can measure the same people over and over, but not the entire survey is made up of that particular cohort. So this survey is important because it's a leading indicator, and according to the University of Michigan, the surveys have proven to be an accurate indicator of the future course of the national economy. Surveys have demonstrated their ability to accurately anticipate changes in interest rates, unemployment rates, inflation rates, GDP growth, housing, car demand, and other key economic indicators. So let's just look at a chart of the U.S. Index of Consumer Sentiment over the last 5 years. And as you can see, starting in 2017, the chart really bounces between 90 and 100. As the economy was in good shape, we had low interest rates until we got to right about here. Here's February of 20. Then when we go into March, this is where the pandemic hit, and you can see the confidence level during the start of the pandemic was at 71.8. And as we go through, pandemic goes through the first year, we're at 79. And then we go through the middle of 2021, we get back up into the 85s. And now you can see since about June of 21, the sentiment level has gone pretty much down. And you can see we're currently at 59.4 as of March 2022. So, can consumer sentiment indexes predict an upcoming recession? Two noted economists believe so and published a paper in October of 2021. Blankflower, a professor of economics at Dartmouth College and former member of the rate setting committee at the Bank of England, and Alex Bryson of the University College of London pointed to declining consumer confidence as a bellwether for recession. Blankflower said he called the 2008 recession ahead of everyone else and told the Post he believes he's right this time too. His recent paper with Bryson studied consumer sentiment from 1978 until now and found that consumer expectations provide an early warning system for the trouble ahead. The recent double-digit slump in two consumer sentiment indexes from the Conference Board and from the University of Michigan provides the backbone of the economist study. Those surveys look at what Americans say about their income expectations, employment conditions, and what they think about the economy in general. The Conference Board in September's read on consumer expectations, for instance, had dropped 25.3 points from March's figures, a high point for the year. Meanwhile, the University of Michigan's Consumer Sentiment Index for September was down 18.4 points from the high it reached for the year in June. Just ahead of the 2008 global financial crash, these indices were ringing similar alarm bells, a 19-point drop and a 21-point dip from the highs of the year ahead of the 2008 global financial crash. All recessions since the 1980s have been predicted by at least 10 and sometimes many more point drops in these indices, the economists say in the paper. The darkening economic picture corresponds with an apparently darkening mood in the country. A survey by the Conference Board released August 31st said 42% of workers were worried about returning to the workplace for fear of contracting COVID-19, a substantial increase from June 2021, when only 24% expressed this concern, according to the paper. Consumer expectations about future economic trends are highly predictive of economic downturns 6 to 18 months ahead, thus providing an early warning system for the economy, Bryson and Branchfeller write. So according to these economists, here's where the 10-point drop occurred, starting the clock on the 18-month time frame for a recession. In July of 2021, the consumer index of confidence sentiment was at 81.2. And when we went to August, it dropped to 70.3, meaning a greater than 10% drop. So based on this information and based on past history, going back to 2007 and 2008, these two economists believe that within the next 18 months, the U.S. economy will be in a recession. At the present time, consumer confidence in the economy is falling. Falling real incomes and surging fuel prices are key drivers of this pessimism. The share of respondents expecting worse personal finances a year ahead is the largest since the 1940s. Consumer confidence data is an important tool we as investors have to be able to adjust our portfolios to better fit within a slowing economy. Of course, prior to investing in any security, make sure it fits within your time horizon and risk tolerance. Also, don't invest in something based on hope. Hope is not a strategy. Know what you own and why you own it. That's all I have this week. Please hit the like button and subscribe if you enjoyed this content. Thanks, and see you again next week.